We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is returning guest Simon Hunt. He's a consultant in the global economy, China, and the copper industry. Thanks for joining me today, Simon.
It's a pleasure to be here, even though it's early in the morning.
Early in the morning for you and late in the evening for me, but I'm sure we'll be able to make it work. So, as you have said in one of your recent letters, the world is full of unseen risks for a generation or more. So, what are some of these risks that we're talking about?
We're growing bubbles everywhere. Enormous amount of speculation in all markets. Stock market valuations have diverged considerably from economic reality. We've got geopolitical tensions, which seem to get worse rather than better, particularly when you look at Ukraine. So in effect, what central banks are doing are blowing bubbles to create a market implosion at some point in the future, because the current financial structure is unsustainable. You cannot have debt continuously growing faster than growth. And that's what we've seen for a decade or more. So navigating these risks is difficult. You can either run with the flow and hope that the risks don't appear, or you take preventative action, which is interesting to note that two supposedly communist countries are adopting very orthodox fiscal and monetary policies, namely China and Russia. Mm-hmm. Russia's inflation is running at about 7.5% year on year. And what have they done with interest rates? 7.5%. China is deleveraging its economy deliberately. If you look at statements that China's leadership and financial advisors, ex-members of the Monetary Committee and ex-PBOC governors, etc., they've all been saying the same thing. We have to prepare for markets to implode outside China because of the fiscal and monetary excesses which the Fed and other Western central banks have been pursuing. They know history, and they know that inflation, if it gets embedded in an economy, is socially destabilizing. And that's the last thing they want to see.
Mm-hmm. So when we think about the social destabilizing effect of inflation, does that start to, in effect, manifest when the population starts to change its time preference to bring their purchases ahead to combat the destruction of their capital?
Well, I think you've been seeing it. Just look at what retail sales have been doing. But on the other side of the equation, if you look at the consumer sentiment indices of the University of Michigan and the Conference Board, they're warning you, they're telling you that prices, inflation is running faster than income. And thus, these indices are suggesting that when we get into the first quarter of next year, if not earlier, you're going to see global business activity slowing very significantly.
So as you lay out, one of the major risks that you're talking about is that there could be this recession that you foresee coming in the first quarter of next year. So what could
well, whether it's recession or a significant slowdown, it doesn't really matter, because the response from the Fed and other Western central banks is going to be exactly the same, which is another burst of throwing money at the problem. Mm-hmm. So what's going to emerge after this slowdown stroke recession in the first half of next year is an even bigger inflation syndrome, which ultimately will collapse the whole economy. But you'll have 2 years or so of very strong inflation-led growth.
So in effect, they're going to be backing off of any tapering talk that they've been tiptoeing towards and supposedly beginning here this month. And once they see that slowdown, they will reverse course completely?
Absolutely.
So what will the reaction by the Fed and other central banks, when they start printing all this money and, as you say, like throwing money at this problem, will that be negative for gold and silver prices?
No, it'll be positive.
Simply because
you will start seeing a complete run out of people will start hedging in a big way. And how do you hedge? You go back into equities and you go back into hard assets. On our work, supported by our technical associate, sometime around 2025, the US dollar index will effectively halve in value, going from 95 to under 50. What is that telling you?
That there's no demand for dollars, right?
Yeah, absolutely.
Mm-hmm.
And what does that do to America?
Well, it sure puts a damper on the way that things have been running for so many years, right?
Yep.
So
that's when we get. We'll have this strong inflationary syndrome from, say, the middle of next year into 2024. And then that's when accidents start happening. Interest rates have been rising. So you're going to cause all sorts of issues within the workings of the financial system. And that's when we start seeing the collapse. And on our work, it won't be exactly the same, but it'll be similar to what was experienced in 1929, 1932. But when we come out of that, effectively we're having washed out debt, then we get into a long period of good, stable growth. I mean, if we go back to 1900, we've gone through long cycles of 40 years. And actually, we ended the low cycle at the end of last year, when growth at GDP, global growth had averaged around 2%. Now we're going back into 40 odd years of 4% growth. but we've got this difficult transition period.
Mhm. So when we think about the path forward for the US dollar, and you're saying, halving by 2025, correct?
Yeah, around that period.
So from now till then, is that just a steady grind lower, or does that 2024 timeframe bring a more of a dramatic event and drop?
Well, all one can say is it's going to be extremely volatile.
Mm-hmm.
I mean, short term, we're probably going to be seeing the dollar index rising to 95, 96. And then it starts falling, but it's not a straight line.
So, Simon, one of the other things that you really bring forward is the geopolitical tensions that there are in the world. So, where is the greatest risk of war, in your opinion, right now? Considering Biden's dwindling approval rating, could a war unite the country behind him?
Well, America has played that card before. Mm-hmm. And there must be a great temptation to play it again. And if you look at the history from 2014 of the Ukraine, and you look at who's been visiting Kiev, America's defense secretary, saying, effectively saying, we are behind you. Macron is about to go to sell arms to Ukraine, to the Kiev government. You've got the UK's defense secretary, I think is in the Ukraine now. What our take is that these visits are encouraging Kiev, having being given arms from NATO countries, including Turkey selling its drones to Kiev, probably manned by Turkish operators in Kiev. And those drones have been bombing Donbass. Putin and Lavrov have been saying quite openly, Ukraine is a red line. You cross it, we're going to be forced to go in. Mm-hmm. So our take is that, emboldened by the arms that they have been receiving from NATO countries, together with the statements of support, whether that's realized or not is a different question. Kiev is very likely to launch a war against Donbass, hoping that NATO countries will fall in behind them. Now, that's a big question. Mm-hmm. But once that happens, then it's pretty clear, and Putin has basically said it, that Russia will go in. And it doesn't matter if NATO forces are in there, it won't take long for Russia to clear the lot out. And then you've got all of the NATO naval exercises in the Baltic Seas, which again, Putin is basically saying, what if we had naval exercises off the coast of America? You wouldn't like it. So I think that there is a high risk that there will be a war in Ukraine. I think you've also got to watch very carefully what's going on in Belarus. That could easily escalate. And if NATO tries to move into Belarus, then Russia goes in too. Mm-hmm. I don't think there is I'm more calm about what's going on in Taiwan. China has no wish to take Taiwan over militarily if they can help it. There are two red lines. One is if America declares open support for Taiwan's independence, and secondly, if Taiwan's president calls for a referendum for independence, then China will have no option. But if neither of those two options materialize, then China's just going to bide its time and compromises will be reached probably in the 2028-2030 period, so that both parties can live happily under one roof. What people don't realize is that 6% of Taiwan's working population actually work in China, about 1 million people. And that Taiwan has been, since the early 1990s, the biggest investor in China, totaling something around $200 billion. So, pragmatism will win the day, unless those two red lines are crossed.
As you say that, those are a couple of factors that bode well for Taiwan's safety until they can reach an agreement, right?
Yeah.
So, Simon, when we think about the slowing Chinese economy, everyone points to the Evergrande default as one of the obvious signs that China may be trying to control, letting some of the air out of its bubble. So, do you think that we have seen the end of Evergrande's fallout and the consequences for China's economy?
I'll answer the question a different way. I think the leadership has seen a golden opportunity to control the real estate sector and take control over from the private sector with its much more speculative operations. And I think you'll find that a lot of the assets that are going to fall due will be taken over by central SOEs, central government SOEs. And this will break the relationship between the real estate, private sector real estate developers and the local governments. And it's all part of this long-term philosophy of centralization of power. All roads lead to Beijing. So that eventually, probably over the next 10 years, you'll find that the authority that local governments have of raising taxes, land sales, etc., will be disbanded. And control of revenues, etc., will be centralized in Beijing.
So when we think about the centralization of power like that, Simon, in your opinion, is that a positive or a negative thing? It does.
You need to step back a bit and actually, what is Xi's objectives? Mm-hmm. And the first I would say is that having a third term of office, which looks likely, is not a self-promotion exercise. It's actually, as a friend of mine in 2014 told me, who was attending the party school, Central Party School at that time, when I asked him, what are you learning? His reply was simply that all our professors are close to our close President Xi's advisors, and that they actually told him that if you want to achieve your objectives, you will need a third term. So what's going on is nothing to do with he's going to be president for life. Mm-hmm. He's president until he's achieved his objectives. And what are those objectives? The primary one is technological advancement. You need that for survival stakes, because if you look at the fall in the workforce for demographic reasons and the rise in the number of retirees, the numbers are huge. So you need to balance that divergence with a sharp increase in productivity. And that's what technology will give them. And that's the real reason why so much focus is being given on A1 and all the new technologies. Sorry, what was the question? Why centralization?
If centralization in this case is a good thing, considering that China seems to be basically, dominating and achieving their objectives. On one hand, we have learned that centralization of power can be a very negative thing, but in China's case, it seems to be positive, considering they do have that, let's say, advantage of having a long-term vision and having the time to be able to achieve those goals the way that they need to over that timeline.
You've hit the nail on the head. It's long-term. It's not short-term. Mm-hmm. And really, the objectives are to create a society that is not elitist but egalitarian, which means focusing on that group of people who have disposable incomes below the average. That number's something like 800 million. Yeah, I know. Greater than the combined populations of America, Indonesia, and Pakistan. Mm-hmm. So that's an enormous potential growth for the economy. Mm-hmm. Rule of law is very high on the priority list. They're getting there step by step in a typical Chinese way, but she has set it out as one of the foundations for the future. The second is, or the third, is to empower the private sector. And you can see that in the new Pudong plan, which was published earlier this year. So the private sector is not ignored. The private sector is very much part of the future policy.
So, Simon, is it possible that we've only seen the start of the supply chain disruptions? Considering that we have seen energy rationing in China, could we see them shore up supplies and start cutting some exports in order to conserve resources for themselves?
I think that is over the next 6 months, I think that is a big risk. I throw out the thought that maybe what the leadership is showing to the rest of the world, look how dependent you are on us. Because it's not just the big items, it's the little things like who controls the supply of brake linings or electrical switches or the bolts for this, that, and the other. And I think my contrarian thinking tells me that this is really one of the big reasons why we are seeing supply chain disruptions.
Not just the fact that the boats can't get offloaded and the trucks can't haul the containers.
This is quite separate.
Mm-hmm.
I think we're probably starting to see the end of the shipping and transport bottlenecks. I think that will slowly unwind itself.
Mm-hmm. So, Simon, some analysts say that China could roll out their digital currency in Q1 of 2022. Do you have a feeling on if this will happen as expected? And if so, could it be backed by gold?
Timing is very difficult. It could be Q1 2022. I think is more likely 2023 because they're going to almost do a dress rehearsal for the introduction of the digital currency during the Winter Olympic Games. Mm-hmm. So I think it's more likely 2023. And at some stage, there will be a formal link. I don't know when that will be, but they have the gold resources to do that. Using Alistair MacLeod's analysis, China has the government has approximately, you get the numbers right, somewhere between 20 and 25,000 tons of physical gold. And the general public, another 17,000, which you can derive from the sales out of the Chinese gold exchange. So they have the resources. So does Russia. Russia's real gold reserves are around 12,000 tons, not the 2,000 or 3,000 that's reported. In China, the gold is held by different government departments. The PLA is a big holder of gold.
Interestingly enough, I spoke with Alistair this morning, and those numbers actually sound exactly what he was saying. So,
good. I'm glad. My memory hasn't entirely gone.
So, what could be the consequences for the U.S. dollar if China does do this, Simon? Could that play into the scenario of the real halving of the value of the U.S. dollar?
Well, I think that developing countries will look around. Do we want to replicate the democratic capitalist system of the Western world? Or do we want to pursue a form of authoritarian government, authoritarian state capitalism that China has taken up? And then you have to ask the question, there's some point in the future when China is going to say, if you want to sell to us, you're going to have to accept RMB. Mm-hmm. Now, before they do that, they have to clean up their financial sector, which they're doing. So when will that be? if I had to guess, it's going to be part of the big crash syndrome. So China's purchases of oil from Saudi Arabia and other Middle Eastern countries, they will accept RMB. So the RMB has to find a market, which will be mostly back into China. And that's really the end of the dollar.
Mm-hmm.
Why do we get the dollar index halving in value? Simple answer.
More attractive options, and
yeah.
no choice to trade with China if you don't choose their currency.
Yeah.
So Simon,
again, timing is a different matter, but I would think it's going to be in that 24-26 period.
Excellent. So Simon, what is the consensus view of where the copper prices has headed? And has this consensus caused you to reevaluate your view, considering that it could already be embedded in the price?
That's a big question. You've got a number of forces at play. Excuse me, not just global supply and demand. What's being played out at the moment, in our view, and having experienced all price spikes since the 1960s, a very similar game is being played on every occasion, which is that certain interests want to maximize their returns, and they start playing around in the markets. The easy one is to take metal out of the market by, first of all, buying from producers, and secondly, from taking metal out of the exchanges and effectively warehousing it outside the reporting system. So the bulls say, look how rapidly stocks are falling. And of course, prices respond to that. Mm-hmm. No comment on what's going on outside the reporting system. When I took the ICSG data back to 1950, doing a net balance of surpluses and deficits every year since then. And what do I come up with? The end of 2020, over 2 million tons of surplus. Now, 2 million tons is what is about 8% of consumption. Now, that makes common sense, that you need an inventory of about that number for the system to operate fluidly. Mm-hmm. Instead of which the focus is on the reporting system, where you see these huge drops in consumption, in stocks. Where's it going? I think there's some big players who, on the end-use side, who are playing a long game and using the big merchants, etc. So what will dampen this game is if we're right that growth slows through into the middle of next year, and we get an outside shock like a war in Ukraine, which would have completely upset the apple cart. And then you get a big correction in the price.
Mm-hmm.
And I think a price correction down to 8,000 sometime March, April, May is probably a realistic assumption. But with central banks and governments then throwing more dosh into the system, sorry, that's an English expression, money, you're going to get an inflation blow-off. Mm-hmm. And then you will find that institutions eager to hedge falling dollar and rising inflation. One of their tools, of course, is we need physical assets like metals. So that will just add to a very strong demand, because this year, because of all the bottlenecks, etc., there's been a lot of unsatisfied demand for things like cars, homes, blah, 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 blah. So I think that next year, from middle of next year, you're actually going to see refined copper consumption up until, say, the end of 2023, growing at 5 to 6% a year. That's a huge number. So you're going to get very big deficits, spikes in prices, huge volatility, and we would have a spike at, our number is 14,000, but it may be 15,000, but it's a spike. Because once you've got to that point, like all previous spikes, you find a collapse. And the collapse is due to A, the macro environment, and B, end users will be saying, how can we reduce our copper content? Different forms of substitution. Utilities will be asking, should we increase our use of aluminium? More importantly, in that 2010, 2014 period, a lot of work was done on high temperature superconductors by a French group called Nexans, a Japanese group called Sumitomo Electric. And there was hope back in 2014 that high temperature superconductors would take off. But then we had the collapse of everything. So that was all put on the back burner. But I think there's a big chance that China will switch to high temperature superconductors and superconductivity in general. The head of the state institution that has responsibility for the cable sector, wire cable sector, actually said that in this decade, we will be switching to high temperature superconductors. Now we have to wait to see whether they will, but that was an official statement. And I'm hearing that there are trial cases going on around the world looking at HTS. And in fact, in Chicago, they've actually put in a high temperature superconductor line, not a trial one. So then there are all sorts of others, like particularly for car harnesses and EVs. A university in northern USA has done a lot of research on graphene copper wires, which actually General Motors has got themselves involved in. And what does this do? it reduces the weight, increases the conductivity, and reduces the copper content. So, I mean, when you get high prices are great innovators.
Mm-hmm.
So producers may applaud high prices, but actually they should be aware of the danger that emanates from them. Mm-hmm. I mean, substitutions goes back all the way back to the late 1950s. So it's nothing new. It's an evolution which gets accelerated when you get these spikes.
As you say, it's great for innovation, but high prices are also the cure for high prices, right?
Yeah, sure. Absolutely. Yeah, absolutely right.
So considering one of these price spikes, Simon, you looked at the data, as you said, going back to the 50s and adjusted it all for inflation. So what was one of the things that surprised you the most about the peak of over $15,000 a ton back in 1974?
Yeah, I did. I put them all into 2021 dollars. I mean, I don't know what to say because they are the peaks and they are the troughs. Mm-hmm. And it's part of copper's history, and it will continue to be copper's history.
Mm-hmm. And as you lay out in your letter, there are a couple different scenarios for prices going up and prices going down. What are the mine risks right now that could drive the price higher?
The big risk, of course, is that financial institutions say, goodness, the dollar is going to fall, inflation is rising, how do we hedge? We're going into the metals. Mm-hmm. And if they make the move, which they did late last year and early this year, it's a very powerful force. So that is the biggest risk in the near term for copper prices to rise sharply.
Mm-hmm. So what about the mine risks that threaten to, let's say, derail supply that is already supposed to be coming online or to the market?
Well, I think the biggest risk on the mine side is the loss of production due to falling grades. And the numbers that I've seen for the next 2022 to 2025 are huge. I mean, 500,000-600,000 tons loss.
Mm-hmm. And that just serves to, soak up or
to tighten the market. Yes.
Yeah, absolutely. Yeah. And then as you mentioned, as we're heading into this stagflationary environment, on the other side of the coin, most of the Western economies are facing this, like I said, this stagflationary environment. So this could dampen demand at the same time, considering that there could be less discretionary spending, right?
Yeah. I come back to the consumer sentiment surveys in America. Mm-hmm. But you're seeing the same thing in Europe. Look at food prices. The FAO's index of food prices in September, or was it October? September was the last one published. The index rose by 13.3% globally. But when you look at the sub-indices, dairy products, vegetable oils, meat, et cetera, they were all rising by 20-40%. So I can't see how they got to the index of being 13.3. This is not a one-off. You look at the real weather patterns, we're probably going to be seeing in the Northern Hemisphere cold spells coming, not warming, implying that the springs are very short, the winter's long, and the summer's probably cooler. If you're a skier, it's going to be great for skiing. So, and then you look at, particularly in Europe, the EU government refusing to authorize the use of Nord Stream 2. So what have gas prices done? So, inflation is embedded in the system through fundamental reasons, not just by the transitory ones of supply chain bottlenecks, etc.
Simon, I think that's a great place to wrap up. Do you have anything else you'd like to mention to our audience before we do?
No, I think you've covered the points very well. Thank you very much.
Well, thank you, Simon. I know we got a lot of excellent feedback on your last interview, and I really appreciate you coming back on the show and sharing your perspective with us and our listeners. Of course, you're available, your excellent research at shss.com. Simon,
Simon at shss.com.
Okay. Yeah, that's your email. And of course, your website is shss.com.
Yeah.
Perfect. Simon, I really appreciate your time today. And thank you so much for sharing your perspective.
Pleasure. Thank you for having me on board again.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.